Welcome to Talk Tickers. Today we're diving into the Q2 2025 update and earnings call that one dropped pre-market August 11th.
Right. And if you just glanced at the stock that day, well, the message seemed pretty clear, didn't it? A lot of disappointment.
Exactly. So our goal today is to unpack that. Is the strategic plan management laid out actually, strong enough to justify the rough financials we saw?
Yeah, it's about separating that immediate P&L hit from the longer-term story they're trying to sell. The conflict is stark. Headline numbers missed badly. But management basically spent the whole call saying, look, the system for getting this product adopted, we just finished building it and funding it.
Okay, let's maybe start with the tough part then, the numbers that drove that sell-off. Because, well, they weren't great compared to what people were expecting.
No, not at all. GAAP EPS came in at a loss of $0.24.
And the street was looking for something more like, what, minus $1.16, minus 17 cents?
Yeah, around there. So a pretty significant miss on the bottom line.
And the revenue figure was maybe even more jarring.
Arguably, yeah. Especially for a product launch trying to gain traction. Q2 revenue was only $0.3 million, just $300,000.
Wow. And the consensus was closer to $1 million. Right?
Almost $1 million, yeah. So when you miss revenue by like 70%, well, the market reacts first, asks questions later.
True, though we should probably note the net loss itself, $37.7 million, was actually better than Q2 last year.
It was, down from $56.7 million in Q2 2024. So, okay, there's some cost control happening beneath the surface.
But still, those near-term numbers, the EPS and revenue miss, that's what hammered the stock initially.
Absolutely. But, and this is crucial for the rest of the story, let's talk cash. They ended the quarter, June 30th, with $88.4 million in cash, equivalents, and restricted cash.
Okay, $88.4 million, that's the runway.
That's the runway for everything else they've talked about, the whole strategic push.
All right, so let's pivot then. Away from the Q2 numbers that everyone saw towards the Q3 story management was painting. They really hammered home the commercial execution piece.
They did, especially the acceleration they apparently saw right after the quarter ended, in July. They're signaling a potential turning point here.
And the big headline was the hospital access, right? The VAC approvals.
Yeah, the velocity there was pretty striking. They reported 82 civilian hospitals are now eligible to purchase. That means they've cleared the value analysis committees.
82? And what was that number last quarter?
Just 5.
Yeah.
5 eligible hospitals at the last update. So, that's a massive jump in potential access points.
Okay, an 80 hospital jump is huge, definitely. But, VAC approval just gets you onto the hospital's formulary, right? It doesn't mean doctors are actually using it yet.
That's the key question. And they tried to address that by pointing to the pipeline. They mentioned another 40 VAC sites are currently under review.
40 more in the queue.
But maybe the biggest news on the commercial front wasn't even civilian hospitals. It was the government channel breakthrough.
Ah, the ECAT listing. That's the electronic catalog with the Defense Logistics Agency. Sounds kind of technical, but you're saying it's a big deal.
Oh, it's massive because it fundamentally changes how they sell into the military and VA system.
How so?
That listing makes the product available to roughly 35 military treatment facilities, MTFs, and about 160 VA hospitals. And crucially,
it bypasses the local VAC hurdles.
For the most part, yeah. It avoids needing that laborious site-by-site approval process at many of these facilities. It's basically a fast track into, some very large healthcare systems.
And they had proof it's starting to work.
They did. The first sale to a U.S. military facility happened in July. And importantly, it was followed by a reorder.
A reorder. Okay, that's significant. It means someone used it, presumably liked it, and needed more.
Exactly. It's that first flicker of real clinical validation in that channel. And that feeds right into maybe the strongest data point they shared on traction.
Which was?
July sales. Just the month of July. Product sales were about $2.3 million.
Wait, the same as the entire Q2 revenue?
More than the entire first half of 2025 combined. So $300 in July alone exceeded the sales for the first 6 months of the year.
Okay, that sounds like acceleration, if that trend holds.
That's the hockey stick curve they need to show, right? But it wasn't all smooth sailing. They did spend some time talking about headwinds.
Yeah, they mentioned unsubstantiated public attacks by certain detractors. That seemed like unusually direct language for an earnings call.
It really was. They said it slowed down the VAC approval process, pushed the timeline from the typical, say, 3-6 months out to more like 6-9 months or even longer.
So dealing with external noise was actually impacting their rollout speed.
It seems so. Which kind of raises the question, right? If approvals are taking longer, how do you make up for lost time elsewhere?
And their answer was, the pricing change. Effective July 1st, they cut the price from $29,500 down to $24,250. That feels counterintuitive when sales are just starting.
It does on the surface, but this looks like a purely tactical move. It's about speeding up adoption.
How does a price cut speed things up beyond just making it cheaper?
It's about hitting a specific administrative threshold. Apparently, that $25,000 mark is often a trigger point in hospitals. Below it, procurement might be simpler. Above it,
More paperwork, full committee reviews, maybe.
exactly, lawyers, consultants, the whole 9 yards potentially. But dropping just below 25Ks, they're trying to remove a bureaucratic bottleneck. Make it faster and easier for hospitals to say yes and get it stocked.
So, trade margin for speed. Get it into more hands faster, even if it costs a bit upfront.
That seems to be the strategy. Sacrifice some margin now to accelerate market penetration and utilization.
Okay, that makes sense tactically. But let's be real, the trauma indication, even with these wins, isn't the biggest market long term. The real value, the big potential upside, that hinges on reimbursement and the pipeline, right? Specifically dialysis access.
Absolutely. The trauma market gets them started, proves the tech, but dialysis is the volume play. And the first hurdle there was reimbursement for trauma, CMS.
Decline the NTT application, the new technology add-on payment. They said it wasn't new enough compared to grafts or veins.
Yeah, that was the rationale cited. Seems a bit odd given the biological nature of the product, but that was the decision.
Management seemed to downplay it, though. They said only about 4.3% of these trauma patients are actually covered by Medicare anyway. Do we buy that, or is losing NTT a bigger blow, maybe reputationally?
It's not ideal, for sure. It introduces maybe a bit of risk perception. But their pivot makes sense. The focus now is all on private payers.
How are they approaching that?
Leveraging the clinical data, obviously, but also pushing their published budget impact model.
Right, the argument that even though it costs more up front.
It saves money long-term by avoiding complications like infections or even amputations. Those are incredibly costly down the line.
And private payers care about those long-term costs, unlike maybe a hospital focus on the initial procedure payment.
Okay.
Makes sense. So shifting gears to that long-term engine dialysis. The V007 trial data looked pretty strong presented at the vascular surgery meeting.
It did, especially in that high-risk group, the patients really prone to having their fistulas fail to mature.
What did it show for them?
Significantly higher functional patency and secondary patency, too, compared to the standard AV fistula. Big clinical advantage there.
And the key metric was how long the access actually worked.
Yeah, duration of usability.
Right.
It's much longer in the group getting the product 8 months versus only 4.5 for the fistula group. And the p-value was, incredibly small. Highly statistically significant.
Wow, 0.000002.
Okay.
So clear benefit for those tougher patients.
It really proves that for the patients who struggle most with standard options, this offers a more reliable, longer-lasting solution.
And that strong data obviously helps build the case for the broader dialysis market. Which brings us to the key trial, V012. That's a phase 3 in women, right? Another group known for fistula issues.
Correct. Enrollment there is moving along. They hit 100 patients out of the 150 target. But the really important thing is the interim analysis.
That got triggered back in April.
Yeah, April 2025. That was when the first 80 patients hit their 1-year follow-up mark. Now everyone's waiting for that data.
Right, because that's the big one, the potential game changer for the stock. When do we expect to see those results?
The company guided towards top-line results from that V012 interim analysis around May or June of 2026.
To 2026. Okay. And that data basically decides if they filed the BLA for the AV access indication.
Pretty much. It's the green light. If the data is good, they expect to file that supplemental BLA in the second half of 2026.
So the pipeline's moving. V007 data strong, V012 interim results next summer, BLA filing potentially after that. Plus you mentioned the CABG program too.
Yeah, the small diameter graft for coronary artery bypass. They're planning to file the IND for that later this year, 2025, aiming for clinical trials to start in 2026.
Okay, lots happening in the pipeline. But It all comes back to cash, doesn't it? Can they actually get to that mid-2026 V012 data readout without running out of money or having to dilute shareholders massively?
And that, I think, was maybe the most critical piece of news on the entire call. The cost cuts.
Right, the workforce reduction.
Yeah, about 30 roles cut, plus deferring other operating expenses. They're tightening the belt significantly to extend that cash runway.
And they put a number on it, over $50 million in savings.
Over $50 million targeted across 2025 and 2026. compared to what they'd originally budgeted. This isn't just trimming fat.
No, that's substantial.
It's management actively buying themselves time. You take the $88.4 million of cash they had, you add $50 million in expected savings, suddenly that runway to mid-2026 looks a lot more comfortable.
So the real financial headline wasn't the Q2 miss. It was the proactive move to cut costs and de-risk the path to that key V016 catalyst.
That's how I read it. They addressed the biggest overhang, the fear of near-term dilution, head on.
Okay, so if we pull this all together, the focus really shifts, doesn't it? Away from the slow start in trauma, which frankly hasn't moved the needle much yet.
Right.
And it becomes all about, one, can they convert those 82 plus hospitals in the ECAT listing into actual recurring sales? And two, can they successfully bridge to that V012 data and unlock the much bigger dialysis market?
Exactly. The key milestones are now clear. Continued sequential growth in commercial orders month over month, and then that V012 interim data readout next year.
It's basically a race against time now. Execute commercially while waiting for the data that could fundamentally change the company's valuation.
If that V012 data hits, yeah, it could be a major inflection point.
Which naturally leads us into our This Is Not Financial Advice segment. Time to put on our imaginary hedge fund hats and pitch a trade idea based on all this.
Okay, let's frame the setup. The stock's obviously taken a beating, down almost 35% in 3 months, nearly 70% over the year as of that call.
Yeah, the market mood is clearly negative, focused entirely on that Q2 revenue miss and the fear of dilution. Very short-term thinking driving the price.
You combine that deep sell-off with the significant proactive cost-cutting, that $50 million buffer, and the clear timeline to a major catalyst, V012.
It starts to look like a potential long-term asymmetric bet, doesn't it? High risk, sure, but the potential reward if V012 works is huge.
Precisely. The trade idea focuses on bridging that gap, getting exposure to that potential upside from the dialysis data while managing the near-term pain.
So what's the specific trade structure we're pitching?
The idea would be something like initiating a synthetic long position, maybe using deep in the money call options.
And targeting longer dated ones.
Definitely. Target something like a 2027 expiration, way out past the expected V012 data readout.
Okay, so using long dated deep in the money calls, what's the advantage there versus just buying the stock?
It reduces the upfront capital outlay compared to buying shares, potentially lowers the break-even point a bit, and it gives you that leverage to the upside if the V012 data is positive. You're basically betting on the timeline.
The core bet being the $88.4 million in cash plus the $50 million in savings gives them enough runway to reach that V012 data point in mid-2026.
Without having to do a really painful dilutive financing round beforehand. It's a calculating gamble that the financial engineering bridges the gap to the scientific catalyst.
Okay. It's definitely high risk, depends entirely on that V012 data being good, but you can see the logic based on the timeline and the cost cuts.
It's an asymmetric setup if the pipeline delivers.
So wrapping this all up for you, the listener, what's the distilled takeaway? Q2 financials, clearly a miss against expectations, no denying that.
But Q3 started with some potentially significant commercial momentum. You've got the 82 hospitals eligible, the EC3 listing, opening up military and VA.
The first military reorder, which is a positive sign, and that strategic price cut specifically designed to speed up adoption.
So the focus now really is execution. Can they turn that access into actual, consistent monthly sales? That's job number one.
And then ultimately, it all comes down to the pipeline, proving that the dialysis data V007, which looked good, and especially the upcoming V012, is strong enough to unlock that next, much larger wave of demand.
Yeah, the challenge shifts now from just proving the science works to proving they can actually sell it and get it adopted at scale. That's the task for the next, say, 18 months.
A critical period ahead. And as always, please remember, this discussion was for informational purposes only. It is definitely not investment advice.
Always do your own research. Thanks for tuning into this deep dive.
We'll catch you on the next Talk Techers.